Welcome back to a new video. I know that I haven't uploaded for 2 weeks, but in today's video, we are going to be talking about why you're not making money in trading. And it's going to come down to your option Greeks. A lot of you don't even understand what they are or how they even work, or you're asking yourself, why am I not making money when the stock's going up? Or why am I not making money when I bought puts and the stock's going down? And it's because your strike price and your option Greeks. With that being said, let's get right into the video and I hope you enjoy. So let's talk about your option Greeks. There are 3 that I'm going to focus on. The first one being your delta. Delta is how much the stock price changes depending on how much it moves per dollar. What I mean by this is that if you buy a share of a stock and it goes up $1, then you make $1, right? But whenever you buy an option, depending on what the delta is, if your delta is 70 cents, you are only going to make 70 cents or $70 per dollar that the option moves. So whenever you guys are buying out the money calls, usually what happens is your delta is usually 0.20, 0.30. So the stock might go up $2, but you're only up 40 cents. And that is because of your delta. So delta is something that is very important and that is overlooked, but that's something that you need to focus on. And that is why I recommend playing at the money or in the money, because your delta is always going to be much higher when you're playing at the money or in the money compared to out the money. Now let's take a look at an example. If you buy SPY and SPY price is 420 right now, and you buy a 430 call, your delta might be 0.20. And let's say that you or your friend buys a 420 call and his delta is 0.8, 0.80. And let's say that SPY theoretically goes up $2, right? So you should be making $2 per contract. But because you decided to buy out the money, your contracts are going to move 20 cents per dollar. So because SPY moved $2, you're going to make 40 cents off this trade, and your friend just made $1.60 off this trade per contract. So I hope that makes sense with delta. And the next thing that we're going to talk about is your theta or time decay. So you guys might be buying options that expire the same day because they're cheap. Don't do that. You don't trade 0 DTEs. And the reason for that is your theta is going to be much higher. So think of trading, as we say, it's a risk on approach, right? You're trading, your options go up and down depending on what people want to buy it at and sell it at. But every day you hold a option contract, it loses value slowly. The value that an option loses money is called theta. So the higher the theta, the closer your expiration date is. So if I buy an option contract that is a month out, my theta is going to be much lower than if I buy an option contract that is a weekly. Let's take a look at an example. Let's say that today is February 7, and let's say that I decide to buy a February 27. We both buy calls, and let's say that we buy 430 calls and we buy 430 calls. On this one, because today is February 5th, we're gonna call it. Today is February 5th, right? And this is going to be our today. We only have 2 days until this contract expires, meaning that our theta is going to be much higher. Let's say our theta is 1.3. That means that every day my option is going to lose $1.3 of its value. So if I have a $4 option contract, if I don't sell it by today, it's going to be down to $3, or it's going to be down to $2.70 by tomorrow, just because I'm holding the contract. The price might have went up, price might have came down, or it might have even been flat. Market might have opened and closed flat. But because my theta is so high and I'm so close to expiration, my option contracts are moving and they're losing value so much faster because of this. Now let's say that I bought the February 27. Let's say that my theta is only 0.30. So here I just lost $1.30. My contract went down to $2.70 from $4. Here, if I bought this one, my contract went from $4 to $3.70, whether it moved or not. So you can see how big of a difference theta makes and delta makes when you put them together and you're trading dailies, weeklies, you're trading 0 DTEs, or you might be swinging and trading monthlies. You need to know what type of trading you're going to be doing, because it doesn't make sense for you to buy a monthly contract if you know you're going to sell it the same day, but it also doesn't make sense for you to buy a weekly if you're going to be scalp trading with it. So you need to put that into perspective and see what you're doing. Now the third and final thing you want to focus on is your gamma. Now once we know all of this, we can put it together like this. Let's say that today is February 5th and SPY is at 420. let's say that I think that SPY is going to go up and I'm going to buy calls. I'm going to buy 422 calls and I'm going to get February 7th expiration. Let's say that the theta is 1.2. Let's say our delta is 0.70, right? So if SPY goes up $1, we're gonna make $70 or 70 cents per contract back. Now, if we don't sell the same day, we're gonna lose $1.20 every single day, meaning that our contracts have to almost double just to keep up with our theta and our delta. Now, in the other example here, we're gonna look at, let's say that we buy 420 calls, and let's say that we get February 14 expiration. Let's say that my theta is 0.4, and let's say my delta is 0.90. If SPY goes up $1, I'm still going to be able to break even very easily because my theta is not very high and my delta is very high, meaning that if the option contract goes up even just $1, I still have 2 days before my theta starts going negative. So that's giving me an advantage. Anyways, if you guys enjoyed the video, give us a thumbs up. If you found it helpful, please do share. I know a lot of you are beginner traders, so I really appreciate everybody that's watching the video. I'll see you guys in the next one.